Will this earnings season throw up some fireworks just ahead of Diwali? Perhaps not. The Citi Research team expects the second quarter earnings to be as dull or as bright as it has been for the past few years now.
And that's despite a relatively low base last year. Joining us now in our studios, like always, just ahead of the earnings season, are Surendra Goyal, he's Prashant Nair, Manish Shukla and Aditya Mathur from the Citi team. Thank you so much for joining in. Surendra, you've said that in your report that it will be as similar to first quarter. First quarter was really bad. This time around also, if I see your report, for the Nifty 50 companies, you've taken 47 companies and you see a PAT degrowth of 10%. Why are you so pessimistic?
Yes, I think if you go sector by sector, so I think clearly in autos, the volume numbers are out there, right? And we have seen how they stack up on a YOY basis. Similarly, in global commodities, metals, if you see the base where the prices were and where they are, you really know the earnings trajectory is going to be weak. And those two are really the sectors which are pulling down overall growth in a big way. Okay, and that is the reason you kind of get flattish earnings, or again, when I say earnings in this quarter, we are focusing more on PBT, because we really have to see on the corporate tax rate, what corporates, how do they approach it, etc. So from a PBT perspective, we are expecting broadly flattish kind of numbers. And as you pointed out, this is despite a fairly good base effect in financials, where there is a significant growth. So if you exclude financials, the numbers will be like double-digit down on a YOY basis. So there are quite a few sectors where the numbers are looking quite challenged. And on the other side, beyond financials, where there is a benefit of low base, and Manish can talk more about it, there are not that many sectors which are really growing well. Even like staples, for example, when we look at it, this quarter we expect just around 10% growth, which used to be higher till a couple of quarters back. IT services, 2 quarters back, the growth was, I think, 15-16% YOY. This quarter we are expecting 2-3% YOY, and that's a large sector. So essentially there are a number of sectors which are slowing down, and then there are a couple of sectors which are a huge drag, and aggregate of that is what the number throws up.
The taxes bit is interesting because a couple of corporates that we spoke to, and maybe some of the ones that you've spoken to as well, were saying that maybe the effect starts getting penciled in itself on the accounting front on quarter 3 and quarter 4. So my question would be, how would you read into earnings if indeed there is a boost, arguably because of this tax cut? Does that in effect improve the metric and your outlook towards the Nifty or the levels, or it doesn't?
No, so it does help, because this is not a one-time gain. Okay, this is a recurring gain, so it's not like it applies only to this year's earnings. It applies to all of future year earnings, and to that extent it definitely helps. But what we really need at this stage is more clarity on what corporates plan to do with it, because we have seen a number of corporates come out and say that they will kind of continue with what they were doing in the past. So I think that clarity is required to really figure out how much of an earnings boost it actually is. Okay, so for example, when we had put out the note immediately after the announcement, we had estimated there could be a 8% kind of earnings boost. Now, based on all that companies are saying, looks like the impact will be a lot lower than that 8%. But what impact will come through, that we possibly will get more clarity in the earnings calls as companies start talking about it in this quarter.
Okay, and just before we dwell into individual sectors, you mentioned about, at least in the Nifty 50 or the 47 companies, the 2 spaces that will be a drag. In the overall coverage universe, where is it that you believe that in a dull earnings scenario, there could be some outperformances? We'll talk about the individual nuances, but headline, where do you expect some positive news?
So again, if you go through the sectoral breakup there, right? So there are not that many sectors like that this quarter, right? So staples, we expect just about 10% or so YOY growth, which actually looks like one of the better ones. And again, then industrials appears, and that's more a MSCI classification issue, it appears as like 68-69% growth YOY. But then there are a couple of stocks which are really pulling the numbers, and it's a smaller sector. So if you kind of look at the sectoral breakup, it's financials. On PBT level, it's up some 80% YOY. And then there is pretty much consumer at 10%. So this quarter, there are not that many sectors. In terms of specific stocks, we have highlighted stocks in the report. At least analysts can talk about some of them.
Okay, Prashant, we'll come to you. One of the sectors that you've reported here that probably will report weak earnings is the pharma sector. Dr. Reddy on the strong side, Cipla on the weak side. Firstly, your sense on why do you believe this weakness will be there? And secondly, because of the adverse US FDA inspections that we've seen, Do you believe that the next few quarters, again, there will be problems because approval simply won't come in, because this will take much more longer than anticipated?
Yeah, so I think, so this quarter first at an aggregate level, numbers will be weak because there are at least 2 or 3 companies who had a series of exclusive or semi-exclusive revenues in their base, not in the over the last couple of quarters, and those are going away from this time. So that will bring down the aggregate. The India season should be good, but everywhere else we see there is some challenge on growth. So in India focused companies will probably see a reasonably decent quarter, but otherwise we don't see any major pickup in growth. And for this sector, since most investors are focused on a sequential basis, when you look at things like US revenues, etc., the drop down in revenues from Sun, Cipla and Lupin in particular will pull the aggregates down. On an ongoing basis, I think irrespective of FDA action, I think US will remain a challenge. So it's not so much the regulatory issues alone, because in most of the companies who have had regulatory inspections related issues, the affected plants are not a big part of their pipelines. So to that extent, launches will continue. So we have seen Cipla has continued Lupin has continued launching products. Aurobindo will have enough launches to make. But the challenge in the US is that the business is structurally a lot more difficult from a capital intensity perspective now in terms of how much working capital has to be plugged there. So that is putting a lot of pressure on growth. And in general, it's a commodity business. So to that extent, we think that on an ongoing basis, you're not likely to see any meaningful pickup in growth out there. And to that extent, what you said will be true, that you will see, US focused companies being relatively less likely to drive big pickup in growth.
Yeah. So, and one of the companies that you said on the negative side will be Cipla. Now, Cipla also has a large domestic front, but Cipla has a history of these one-offs and all these issues. You think that that is something that is continuing to plague the stock because it's trading at record lows now?
So Cipla's issue for this quarter is that the trade generics business, which saw some disruption at the beginning of the year, I think the general expectation is that there will be some recovery in the second quarter and we'll get back to normal from the second half. Our sense is that will take a bit longer. It will probably be only by the end of this year that they get back to levels they were last year. So that's what will drive, and it's a high margin business, so that will drive numbers down. In the US as well, our sense is that their base business has dipped a bit lower compared to what they were same time last year. It was hidden over the last couple of quarters simply because of exclusivity sales they had. With that exclusivity having run down, the real numbers will come through. So this quarter will remain challenging and it will probably pick up slowly over the next couple of quarters.
Okay, and which of the set of earnings within this space are you really watching out for? Because the news isn't the most positive. Every day of the last few days, we've had a spate of bad news. From an earnings perspective, what is it that you're watching out for the most?
So from an earnings perspective, firstly, we think the hospital/lab services companies will all record good growth. As I said, this has been a good season from an anti-infective standpoint. That benefits outpatient flows, that benefits testing, etc. Secondly, India-focused companies, companies who have larger share of India businesses, unless they have some specific issue like Cipla had, should be decent because the season has been good. And the other company we think will surprise is Dr. Reddy's. They have this cost reduction effort that's been going on. They had a very tough time in the first quarter in their PSAI business. That will recover. So I think that's the only company where we feel, outside of healthcare in India, where you could see a positive surprise.
Okay, and we'll come back to some nuances as well. But financials, and Surendra mentioned this, that within the coverage universe, that's along with consumers probably, or staples, the two pockets. Chalk and cheese, isn't it? I read your note which said that quarter on quarter, the NI growth might not be as strong. But are you bucketing it into the quality banks, which might still continue to do well, versus the weaker banks? And then even in NBFCs, some which might just disappoint massively and some which might perform well.
Yeah, sure. So first, the overall growth, even for banks, has moderated, right? In March, we were at 13% system loan growth. We've come down to 10%. So that kind of drags down your NII growth. On a YOY basis, banks should still do better on margins because funding costs this quarter actually came off so banking system was flush with liquidity. So banks will benefit from that. So there will be a tailwind in terms of margins. Now, interesting thing, obviously, for a long time now has been provisions, and we've been discussing this time and time again. There, I think it will vary from segment to segments rather than bank. So I think large corporate as a stress, I think that will see continue to decline across the banks. Large corporate stress should come down. Pockets of stress might be in real estate or construction finance, and some bit in the mid-corporate because of the series of rating downgrades that we've seen. So now that will vary from how much of a particular bank has exposure to those segments. The other thing which Surendra mentioned is on tax rate, and that can have a lot of implications because for banks there are two things. One, they are one of the biggest beneficiaries because they pay the marginal tax. Our sense is some of the banks might want to use that tax benefit to boost the provisions. So they would end up probably making more provisions than what they would have normally done. Second is there is an impact of deferred tax assets for banks. So if they choose to go to the 25% tax rate, there will be a one-time deferred tax hit, which will again impact the reported P&L adversely. So those are the dynamics. So rather than banks, I think it is the individual segments that we need to look at. And large corporate, retail, very comfort. There's not much of stress there. But it's this mid-corporate space and real estate, which is what we need to really watch out for. And NBFCs, as you rightly said, barring of some of the larger NBFCs, funding environment was reasonably tight during the quarter. So it is a double whammy of sorts where growth is slow and margins will probably remain under pressure because of higher funding costs.
What about the housing finance companies? Will they be the worst hit this time around, given what we've seen? You've seen how Piramal Enterprises has reacted. You've seen some of the others like Indiabulls Housing Finance. The ones that have exposure to the real estate sector, will times be even tougher for them going ahead?
Yeah, so unfortunately, if you look at stock prices today, anyone who has any exposure to real estate is being painted with the same brush. And each of them don't necessarily have the same structures or same collaterals, etc. in place. So I'm not sure if the way stocks are factoring in that everybody will be down is the same extent. But at the same time, we do need to acknowledge that the stress in that segment is high. We've seen a couple of NBFCs report higher NPAs in the June quarter itself. That trend up will continue. But we are not convinced if all NBFCs or all real estate exposed NBFCs would necessarily see large amount of stress, which is what some of the stock prices seem to be indicating. Growth, of course, is a different argument. Growth will definitely be slower.
Okay, and we'll come to consumers as well. I want your view on what the financials do, but just one follow-up to that. The two names that have already come out with their updates and two leaders in their respective segments, if that is indeed a sign of things to come, wherein there might be some moderation in line with the guidance that they've given, HDFC Bank and Bajaj Finance. But would you believe that this flight to quality and the premium valuations, especially in the financial space, would stay as is? We've seen that happen in top quality insurance company, top quality banking name, and the top quality NBFC as well.
Yeah, so if you take, let's say, last 1.5 months, trades have been in two parts. Immediately after tax rate cut off on 20th September, there was a swing, everything moved up. But over the last 2 odd weeks, that again has gone back to the quality perception. And that's because of the emerging concerns on the real estate and mid-corporate space. So to the extent that current environment prevails, I think this flight to safety quality would probably continue. And the better companies would probably, you'll see that valuation differential persist till such time that individual companies are able to come out and demonstrate that there is not much stress or liquidity is fairly comfortable. But for now, what is playing out will probably continue.
Okay, and just before we get to consumers, Surendra, come in on this because it's across boards, right? The consumer sector or otherwise the financial space as well. Do you think earnings will justify this whole valuation, not bubble really, but that stark premium that we're seeing?
So again, I think it's becoming more and more difficult to justify those valuations.
On back of earnings?
Yeah, because I think some of the stocks with the kind of re-rating which has happened because of the dynamic that you spoke about, where everybody is migrating to the same small set of stocks, those stocks have become very expensive. And the moment you are seeing a slowdown, right, and you are seeing those valuations come off. We saw some names in the auto space, right, which 1 year back there was a perception that they can do nothing wrong. Today those stocks, even while they have been executing relatively well in a challenging environment, stocks are down 30, 40, 50%. So I think that is becoming a challenge, that unless the numbers are supportive, if valuations are so high to begin with, I think that's a risk which you have to run with.
Yeah, I think one of the sectors which has stocks most highly valued is the consumer space. You have your Avenue Supermart, you have your Nestle, your Titan, Pidilite, all these Asian Paints again. Is that a risk that people run? Because on one hand, numbers are not expected to be that good. But at the same time, they're trading at valuations. See first quarter, while how the paint companies, despite not the best numbers, they've managed to rally. How do you play this entire thing?
I think, Darshan, the gap between the relatively highest growth companies, the companies which are performing relatively okay, and the ones which are not, is actually the highest that it's been. And I think this is a global phenomenon.
Yeah.
Our global team actually put out a report earlier this month where they've said that the gap between the quality, relatively better performing companies versus the ones which are not is actually the highest since 2001. And I don't think it's very different here in India also. I think you're seeing that wherever you have a relative growth comfort, the investing community seems to have sort of rewarded them with a lot more. The valuations have definitely gone up a lot more.
Nestle is one of the stocks that you said that probably might be on the weaker side. Despite you believe that valuations again here is a concern, or you believe that they're
I think the simple point that we're trying to make there is that vis-a-vis the expectations, where Nestle was actually one of the companies last quarter which did a double-digit volume growth despite all the gloom and doom. We think that may be at a risk, and we might see something more moderate and see a high single-digit growth this quarter. And I think more importantly for the F&B companies, this is true that the commodity cost pressures are definitely have inched up QOQ. And therefore, the core earnings, X of the tax cut impact, might actually get affected vis-a-vis where the expectations are. I think that's the point that we're trying to make for this quarter.
A simple framework to think about that, the earlier question which you also asked, is say a couple of years back for say 15% growth on a consistent basis, suppose you were getting 40 times, and again it's any sector. Today for a much lower earnings, okay, at 10% earnings, you'll get the same multiple or higher multiple because earnings are scarce. It's not a problem with India. Or even our global earnings forecast this year is 3% growth. So earnings is a challenge everywhere. So for consistent earnings, even if they are a little lower than what they were 3 years back, 2 years back, you are getting a higher multiple. But the point we are trying to make here is that suppose there is an expectation that, okay, this was growing at 15, now it's growing at 10, but suppose you get 0. That is when I think the risk on this, some of the stocks where people are hiding. Okay, there are 15 stocks where everybody is hiding. And that is where the risk is that 10%, which is a lowered expectation, if earnings actually come below that, I think that will be a risk to the multiples.
So then let's try and dissect this. In your coverage universe, which of those companies do you reckon will post earnings as per your math in line with your expectations, or maybe possibility of a slightly better earnings delivery?
I think earnings in particular here, I think companies like Asian Paints and maybe Marico, I think stand out clearly. While we're talking of a 9% PBT growth at an aggregate level, these companies should be comfortably at least double of that, if not more. And I think that's also got to do with the raw material tailwind specifically to those particular companies. So I think those two stand out clearly. D-Mart definitely stands out, where we think that the earnings growth will be very, very good. But I think other than that, I think in the HPC space, we are definitely seeing a moderation across the board. In the F&B space, I think, as I mentioned, given the cost pressures, given that the headline volume growth will be a little more challenged, given whatever pressures we are seeing in rural as well as urban general trade. So we are seeing a moderation across the board otherwise.
Okay. This morning we spoke about IT and what IT companies could do, and the expectation, at least based on what the terminal indicates, is that while it's a strong quarter seasonally, a focus on the operational numbers and most companies will beat. What do you expect the sector to do? What do you expect TCS, which comes out later today, or Infosys, which comes out tomorrow, to do?
So I think what we expect is a few trends will be very visible, that growth is slowing down a little compared to what it was. Okay, and that's purely a function of the global macro. You have seen trade war globally impact a few segments, particularly on the manufacturing supply chain side. Financials, particularly capital market businesses, are generally challenged, and that's an area which is pulling back on IT spending. So there are multiple areas where you are starting to see issues. So I think directionally growth will only slow down. Having said that, IT is not a very volatile sector. Okay, so when I say slow down, you'll go from 8% growth to 6% growth. It's not like you go from growth to degrowth. So I think when you are thinking about IT, I think it's becoming more and more difficult, because you have to think of it from an absolute perspective and then relative to the broader market perspective. on an absolute perspective, if today India was doing well, I would have been very comfortable being negative on IT because valuations are 1.5 standard deviation above mean for earnings, which is decelerating quite significantly. Like for example, in this quarterly preview, if you look at the IT stocks we cover, the earnings growth is 2% YOY. 2 quarters back, that number was 16% YOY. So that's a massive deceleration. But today, given that the rest of the market is also challenged, which is what is kind of supporting these stocks, because when I said 15, 20 stocks where people are hiding, definitely 2 or 3 of the IT stocks are as part of that list.
Okay, but sorry, just part 2 of my question before Darshan takes over. What about the big boys, TCS and Infosys? What do you expect them to do?
Again, trends I don't think will be that different because I think you will see things slowing down. I think at least the key debate in some of these companies in TCS, the first point which people ask is, will they be able to achieve double-digit growth? Because in April, when they had guided for this year, they seemed to be pretty comfortable. So even at that time in our models, we did not have a double-digit number. So even now we have a number which is lower than double-digit, and in my view, given the macro, it's a tough ask. Although TCS obviously is a great company, they have been executing very well over the last few years. But even then, in this macro with their size, I see it very difficult that they can get to double-digit growth. So that's the question which we get most often on TCS. Infosys, I think, clearly has had some good deal wins. That momentum is back. So to that extent, I think they should be able to deliver double-digit growth. But again, when I look at expectations, that's where the expectations are. Okay, but I think the sentiment in the market right now with what it is, I think if they deliver what people are expecting, that may be good enough in the near term.
You think that going ahead with what we've seen, initially it was the big 5 large caps versus the mid cap. Now, over the past few quarters we've seen, it's just the top 2, Infosys, TCS, then comes the 3 and then the mid cap. You think that valuation gap will continue and people will continue to prefer more these 2 companies, the large caps, and then, because you've seen how HCL has also reacted much negatively to the news flow, how TechM has reacted. Do you think money flow will continue to the large 2 ones and then the others will, again, they will not?
I think that is still related to the risk appetite in the market. We are seeing it across sectors where there is a polarization to the top 1, 2, 3 names in the sector. So interestingly, we highlighted this in a note a month back, where if you take a basket of Tech Mahindra, HCL and Wipro, okay, and another basket which is TCS and Infosys, the discount which the second basket has to the first basket is at a 15-year high. Okay, and which I think is more a function of the risk appetite in the market. Nobody really wants to be in any of the smaller names which are even less liquid, where there's a risk of a disappointment. Everybody is kind of migrating to the same stocks, and which is why this is happening. So I think it's more a market phenomenon. If people start feeling a little more comfortable, some risk appetite comes back, I think you can actually see that trade reverse. But for the time being, I still think it may continue.
What's your view on the mid-cap valuation on the IT front?
See, the mid-cap valuation, the range is fairly big. Okay, so even in my coverage, I have stock at 11 times and another one at 16, 17 times. So the range is fairly big. Mid-caps will always remain very, very bottom-up, company-specific. So that's been the view which I've always had. In this kind of an environment where the macro is tough, in general, I'm more comfortable with IT large caps over mid caps. That's something we have been saying through the course of this year. That remains unchanged. But yeah, within mid caps, it will always remain a very company-specific call.
Okay. Yeah. Revenue guidance upgrade for HCL Technologies, I presume, is also in order. So let's wait and watch if that were to happen. Wondering this is the broad trajectory of what the earnings could deliver. If I were to dwell it down to specific pecking orders on individual sectors, Prashant, starting off, what is your favorite, and is it an earnings-led call, or is it a valuation-led call, or an event-based call?
So you're talking about stock preference orders outside of just earnings, right?
I mean, whether it's an earnings-based call or otherwise. Okay.
So firstly, in terms of broad areas, we like the services, so healthcare delivery over pharma. So within healthcare delivery, we like Apollo Hospitals the most, followed by Dr. Lal Path Labs, and that's a combination of multiple things. Earnings will be strong, plus I think that entire space is going into a low capex phase, which will mean operating leverage, improving margins, improving return on capital, and generally the street rewards these stocks in such times. On the pharma side, it's very stock specific, not necessarily related to earnings. So the 2 stocks we like the most are Biocon and Aurobindo Pharma. Neither of them will have a significant beat in this quarter, So the reasons we like them, Biocon is primarily a biosimilars play. We expect second half to be quite strong in terms of ramp up. And Aurobindo Pharma, we feel that the diversification in the business will help them grow despite any concerns. Currently, it's related to compliance, but in general, concerns related to the US market, etc., they have generally been able to outperform despite all of that because they are fairly well diversified and there's no dependence on any single product or single plant, etc., which allows them to outperform. So these are the 4 stocks that we like the most, across both delivery and on the pharma side.
Okay, very quickly before we move, Dr. Lal, not a cheap stock, valuations is high. Do you believe that they will be able to sustain valuation with, Metropolis catching up, the unorganized market catching up? Is that something that...
So unorganized players we think will keep losing share. Okay. And players like Dr. Lal we cover, Metropolis we don't, but any large organized chain in our view will keep gaining share because they are able to get closer to the customer, they are able to invest more in terms of customer experience, etc. So that we think that is a play which is a multi-year play in our view. We think valuations will hold and growth will help the stock perform. And because this is a business where there are not too many moving parts, if the industry is growing at 15-16% and the leaders are gaining some share, there is very strong visibility that this will keep giving you that growth. And generally for such businesses which also generate cash, we think market will pay a premium multiple. So we expect premium multiples to hold. We don't expect a re-rating, but then 18-20% earnings growth, that's what I think the stock will compound at.
Okay. In the banking space now, yesterday the Bank Nifty had a big fillip upwards. Now there could be multiple factors and 2 or 3 theories that I think all of us have heard about why this could have happened. But my question is, based on earnings, leave out the HDFC Bank, Kotak Bank variety, which is anyways priced to perfection, and let's leave out IndusInd Bank and Axis Bank as well. The rest, corporate facing banks or otherwise. So put in an ICICI Bank there, put in some of the mid-sized names if you have them within your coverage, Federal, DCB, etc., etc. Where do you think the earnings delivery for this quarter or the next 2 or 3 quarters doesn't have any major hiccups?
Yeah, so among the larger ones, very comfortable with both ICICI Bank and HDFC Bank in terms of earnings delivery. In case of ICICI Bank, their downward trajectory on credit costs should continue. They also are sitting on very high NPA coverage relative to peers. So to that extent, that is something directionally which will be there. Among the mid-cap banks, given the stock correction, etc., we've recently upgraded Federal Bank and RBL Bank to a buy. We believe that given where the valuations are in those stocks and the fact that they don't necessarily have exposure to many of the, for example, in case of Federal specifically, all the names which have come off, they have either negligible or no exposure. So to that extent, we are comfortable on Federal and RBL from a valuations perspective.
Are you being a braveheart and giving out such a similar call on any of the NBFCs which have corrected, and you think that you can go out and take that, not a punt really, but bit of a joker bet?
No, so in case of NBFCs, the stock performance of real estate exposed NBFCs is going to be pretty difficult to call. And while earnings might be, let's say, decent, I'm not sure if the stocks will react immediately because there will always be that fear. So to that extent, among the NBFC space, we like Shriram Transport Finance, where while growth has moderated in the new CV, I think used CV more or less we should be there. And we don't yet see any kind of asset quality stress in their books. And valuations wise also we are comfortable there. So among the mid-sized NBFCs, we'll probably say Shriram Transport.
What about the public sector banks? Anything that fits the bill here?
So public sector banks, first from an earnings perspective for this quarter, DTA can be a large impact if it has to be charged to the P&L. So on a reported earnings basis, that might be a drag. And outside of State Bank of India and Bank of Baroda, most of the banks are preoccupied with merger, right? So that is an added leg of issue there. In case of SBI, there are concerns around their exposure to some of the housing finance companies, etc. But I think valuations are reasonably corrected, but you will not get anything in the current earnings for you to give that confidence to go and buy those stocks. You would need to be patient with an SBI or BOB for that to start showing up in earnings and hence the stock price. 2Q earnings, I'm not sure will be that kind of a confidence booster.
And Aditya, in terms of FMCG consumer names, despite high valuations, which are the stocks that you're telling your clients, okay, that let the earnings be aside. These are the stocks. It could be anything. It could be earnings. It could be valuations. That these are the few stocks that probably will gain traction over the next few quarters.
So Darshan, this is after a very long time we have fewer buys than neutrals and sells in our space right now, and I think we have to kind of keep in mind both the growth as well as expectations on the outlook for the, let's say, at least for the medium term, as well as where valuations are trading to get a reasonably balanced risk reward. The ones that we like are actually Dabur and Marico in the HPC space. We actually like ITC at the current valuations. I know it's underperformed quite a bit. And I think in the discretionary pack, we downgraded Titan yesterday despite the company doing pretty well because we just think that the current valuations are pricing in all the medium-term upsides pretty well as the fact that a combination of a slower market sentiment as well as a very volatile gold price environment could have some risk to the expectations. So I think Jubilant is the name in the discretionary space which we have a buy on as of now.
And which are the sells? Which are the stocks you believe are overvalued, or have other reasons?
I mean, the stocks that we have sells on are actually are actually DMart, the liquor companies, as well as those are the ones that we have sell on.
Okay. Before we wrap, just one pocket that we haven't quite spoken about at length, or two pockets maybe. One is telecom, right in the middle of news, and then autos. And because the conversation with dealers, and we had conversation with 3 dealers about how the festive season has gone, and they were saying that for the first time in a number of months, they saw higher footfalls and some conversions as well, and they believe October will be substantially better. Any thoughts here on both of these pockets?
So I think on autos, the key is sustainability of that trend, because right now what we would be seeing is some kind of pent-up demand coming through. Because last few months have been tough, there was uncertainty, so people would have postponed their decision making. So that may get reflected. But I think couple of 3 months or 3 months, if it sustains, I think that is what will give people confidence. And given that backdrop, we still where we are in terms of the cycle, we are still negative in our model portfolio. Autos is still a significant underweight. On the telecom side, it's a tougher call. Okay, so telecom, we have been overweight right through the start of this year, because our view was that we were at a point where a lot of the competitive intensity has played out, and there are practically, it's become a 3-player market from a 10-player market. And to that extent, even if at the margin you see some improvement, the risk reward was looking very favorable. And which is what today we are seeing that kind of starting to play out, a little bit of a change, and people are feeling a lot more comfortable with the sector. So telecom remains an overweight for us. It was an overweight since the start of the year, and autos is an underweight for us. Okay. So that's what it is.
And as we wrap up, one final thought, Surendra. We've spoken at length on all spaces, almost, save for pharma, unfortunately, about the polarization that we're seeing between the haves and the have-nots, so to say. And the market at large, the large cap versus mid cap, there is also a bit of a stark polarization. Do you think the next 18 odd months, we could actually have the re-rating play out for the mid cap space? Can mid caps outperform large caps?
So I think for that, you need to have comfort on the growth recovery. You need the macro to be supportive. You need that visibility on growth to come back. If you go back and see, at any point, mid caps typically perform in a good economic environment, right? And right now, there are still concerns around growth. And with that kind of a backdrop, I think there is still enough risk aversion, which will not allow that to happen at least over the next 6 to 12 months. And then again, depending on what the government does, what steps are taken, etc., if people start getting a little bit more comfortable, that's when I think that can play out. But at this point, I would be more comfortable owning large caps over mid caps.
Okay. Gentlemen, all of you, thank you so much, as always, for taking the time out and being with us in our studios. It's a pleasure having you every quarter, and this time was no different. And viewers, thanks for tuning in to this very special broadcast from BloombergQuint.